Hey, what's going on, everyone? Today, we're just going to jump straight into it. We're doing exercise 16.7. So, on your textbook, as you're about to see, that is on page 404. I'll just zoom that in a touch. We'll just get that a bit more in. Yep, we can see page 404 and the workbook for your coursework, page 312. So those are the two pages, or the two main focus areas. So today we're reporting depreciation, and we're going to be doing a full set of, well, not full set, but we're going to be using all the reports, so we can go from there. So you see we've got the balance sheet, or the assets and equity, so an unclassified balance sheet for the last month, and then we have a cash flow statement for the next month. So I'll just go through those. They've got bank, they've got inventory, they've got accounts receivable, shop fittings, and accumulated depreciation. So that's all the asset side. You've got equities, accounts payable, GST payable means they owe GST to the government. Loan, okay, so that means we're going to have to split that into current, non-current, and the capital, all things we're going to have to put on reports afterwards. Looking at the cash flow statement, we see there's nothing in investing, so that shop fittings is going to stay at 50,000. But then we've got operating. We can see we had a net cash inflow from operating, 4,560. We've got the outflows, which consist of payments to accounts payable. We've got wages, interest, advertising, rent, GST paid. So immediately, the things that stick out are these four: the wages, interest, advertising, and rent. They are expenses. Those are things I've put as expenses before. They're not really that shocking. So if I was in a SAC and it was reading time, I'd make that note. We got, for the inflows, cash sales, receipts from accounts receivable, GST received. The only one of those that goes on my income statement would be cash sales. Now, the reason I'm talking about income statement is because there are three reports: the income statement, the cash flow statement, and the balance sheet. We've already been given the cash flow statement, so it's kind of a bit logical we're probably going to be doing the income statement. Now we have our inflows. We've got capital contribution, drawings, and loan principal. So you can see we paid $1,500 for the month. That's important later. We've got drawings, pretty stock standard stuff. That loan principal will tell us everything we need to know about what the current liability is. So I will unpack that for you. Then we see a net cash outflow for financing of $6,700, net decrease in cash position of $2,140. You add your bank at start, grab from the balance here. And you can see that we have a bank overdraft next month of $490. So that's our cash flow statement done. Don't need to do that. We've got the extra info on the credit purchases. We've got some inventory. We've got the cost of sales. We've got stock on hand according to the inventory card. We've got sales returns, which are going to go on the income statement. And we've got an inventory loss of 200. So if our inventory loss is 200, that means that the physical stock count we did was 200 lower than it was, so it's 200 lower than what actually happened. So that means the physical count was 66,500 because that's $200 higher than what's counted. Shop fittings, 12% per annum, and the loan is repayable at $3,000 per annum. So I'm going into this blind, by the way, as if it was a SAC. And so the inference I made about the loan principal, they do it in 2 6-monthly payments. So that's the trick, is to go autopilot. Yep, 1,500 times 12. Yeah, got to be that. And then it's actually, hang on, no, read that a bit more closely. So just a little fun fact there. So let's explain how balance day adjustments ensure revenue in the financial reports. So balance day adjustments ensure relevance in the reports because it ensures that all required information is included by having this required information, it means that material factors are considered in the decision making of the business. What's the business? In the financial reports, using financial reports. I realize it says financial reports. So you're saying what balance day adjustments, like how it ensures relevance, and you're saying what relevance is. So you gotta sort of say what both are. B, depreciation on shop fitting. So we're gonna calculate the depreciation. So DEPIN equals historical cost multiplied by, I'm just gonna bring up my calculator out, historical cost multiplied by depreciation. And then it's 50,000 because we've got that below. We see, oh, it's 50,000 multiplied by 12%. And then we go 50,000 multiplied by 0.12, and that gives us a $6,000 amount. Now, that's per annum. So that's per annum. So 6,000 divided by 12 is 500. Love to see it. Because remember, we've got to do it for 1 month. So it's divided by 1 over 12, or times 1 over 12, or I was a bit lazy, so I just went like that. But you can do it either or. You're still going to get 500, which is sort of the main point. Whoopsie daisy. Alright, so let's now do their income statement. I'm just gonna, there we go. Let's knuckle this out. So we've got revenue. First thing we need to do is the revenue for an income statement. So let's put the cash sales in first. Cash sales, none of these other things are relevant for the revenue section. So we've got cash sales, credit sales, less sales returns. So there were sales returns. So we go, cash sales were 8,000. I will tidy this up in a moment. I will just tidy, actually I'll do it now. Credit sales we see is 40,000. Then we get 48,000. Our sales returned is 1,200, and that will give us minus 1,200, 46800. So 46800, then less cost of goods sold, cost of sales. There is nothing else on the cost of goods sold apart from cost of sales, so that's 18,000. So our gross profit is 46,800 minus 18,000, 28800. And then less inventory loss and adjusted gross profit. So we're just gonna plug those numbers straight in. So we go back, we go inventory loss of 200, and our adjusted gross profit becomes 28600. So that's our starting amount. Now we need to go, I'm gonna cheat. Normally you would put it down here in the next line. I don't think it's too pertinent, but whatever. Less, we'll put it in the bold bit. We've got the space, so why not? Less other expenses. And the first thing I'm going to grab is depreciation I previously counted. So depreciation of shop fittings, so I don't have to go back. And I know that's 500. And yes, I will reline those. So I'm just going to go through and go, okay, none of this, all of this we've already included that, or just included this, and the principal of loan is not an expense. So now I just need to go up and put these 4 items I said here. I just need to do that. So we'll go wages. I'm just going to move this across for my own help. Wages 18600. Interest is 100. Advertising 800. Rent 600. I probably could have moved that down the line in hindsight. Let's do that now. Love to see it. So we've got wages, we've got interest, we've got advertising, and we've got the rent. And then the net profit. So let's put our numbers in. We'll go 500 plus 18600 plus 100 plus 800 plus 600 is 20600. And then the net profit, we start off with 28600 minus answer, because the previous sum we did was our expenses, and we're left with a net profit of 8,000. Hooray! Go us. So now I just need to readjust all this. And I oops. And that is our net profit for the period. So let's move on to D now. If you do need to catch up, I recommend you pause to the point and just make sure you get the answers down, by the way. D, explain 2 reasons why that bike shop was able to earn a profit despite suffering a cash deficit in 2025. So what I'm going to do is I'm going to try and bring both up. All right. So how did they earn? This is going to be a little messy, and I am sorry in advance, but this is okay. All right, so you can see here, I've got the cash flow statement just in the corner here, and I've got the profit and loss, or the income statement. So how did I earn a profit? How can I earn a profit as a business while having a cash deficit? And I'm on the wrong exercise, I just realized. Whoopsie daisy. What are the joys of trying to manage this? So we'll get on the right one. How do I have a cash deficit of 2,140 but a net profit of 8,000? How have I done that? So there's a few reasons for that. So we've got to look at what is a cash outflow that doesn't result in an expense, and what is a revenue that doesn't result in a cash inflow. So we've got to sort of work around those. So the first one that sticks out is credit sales, because it's the reverse of this, and you would have seen the list already. So we've got credit sales. Then we have a look at the cash flow statement, and we go accounts payable. That's a cash outflow, but not an expense. You could go GST pay, but I probably don't like that as much as I do drawings or loan principal, because those are bigger amounts. So you've got accounts payments to accounts payable, you've got drawings, you've got loan principal. They're your big 3. And you've also got credit sales. So you can pick those 4. And then you just got to say why. So I'll just move the textbook back to the other monitor. Beautiful. We're all back and we're all running. D. So, explain 2 reasons why they were able to earn a profit despite suffering a cash deficit. Reason 1, and you got to explain why. I would start with credit sales. And you just got to say credit sales increases the revenue the business has earned for the period, but leads to no increase in cash for the same period. Because you've got to know that what's cash, what's profit. That's the main one. On that note, so number 2, I'm going to pick, what do I pick from the cash flow statement? We'll go drawings. Drawings decreases, actually, no. We'll go payments to accounts payable. Whoops. There we go. Nice little fix up. Decreases the amount of cash the business has on hand, as it is an outflow, but this does not increase or impact the income statement. So we're acknowledging this payment, and then we'll also go and put our others in. But we're essentially saying, hey, this decreases cash, but not anything else. So other things you can put in, if applicable, is any payments made to purchase a non-current asset, loan, principal, repayments. Alright, beautiful. That's now out of the way. E, we got to do the accounts payable balance, accounts receivable balance, and accounts a GST balance. So let's put so we got start plus total purchases. There were no income or discounts given. Now remember, we'll put credits purchases. Don't include your cash purchases here. Inc. GST. Now we're gonna put it on both. Cash received, total credit sales. There we go. Alright, let's plug our numbers. So we go from the start, we look at the balance sheet, we go accounts payable was 18650. 18650. I then go to dot point, I go to the dot points. I see the credit purchases 15,000 plus GST, so we add times 1.1, and that's 16,500. Minus the cash paid, which was 20,000. Whoops. That's going to give me a final amount of 18650 plus, whoops a daisy, plus 16500 minus 20,000, 15150. 15150. Make sure you always put your answers in the box. I can't stress that enough. Alright. Time for our cash received at start. So it's the exact same, where we go 40,500 plus total credit sales minus, and I'm only going to do this cash received because I see it right now, 36,000. I just need to get the total credit sales up, which was 40,000 plus GST, but it's 44,000, guys. It is 44,000. And then 40500 plus 44,000 minus 36,000, which we got from the cash flow statement, and that's 48500. So let's put that in 48500. Let's remove all this, and then we go 48500. Now GST is a bit different. Now there's no GST settlement, so this is a pretty straightforward one. There is sales returns we do need to be aware of. Oh, actually, minus sales returns Inc. GST. There is some sales returns. There wasn't purchase returns. So 1200 plus GST makes it 1320. So just a quick little adjustment there. So 48550 minus 1320, 47180. There we go. Yeah, so that was a bit annoying. I did screw that up a little bit. Whoops daisy. So, GST payable, let's smash it out. We've got start plus GST in cash plus GST, CST. It's kind of CST now. Cash minus GST, oh, that should be in credit. I don't know what I'm doing today. Out cash minus GST in, out credit minus GST sales return. I'm just gonna, oh no, it does fit. So let's put those numbers in. So I'm gonna start with just the credit sales, and I'm just gonna be using some placeholder numbers. So the credit sales were 40,000, then you got to add the GST, which makes it 4,000. Then that's our cash, and this will be our credit, which was 15,000 plus GST, makes it 1,500. And then we've got our sales returns, which is 1,200 plus GST is 120. So we're doing those numbers off the credit one just because it's on the screen in front of me. We got GST received, which was 800. We paid 140. And our starting amount we grabbed from the balance sheet at the beginning is 1,900. Now, it's always, if it's a payable, it's always a positive. If it was a receivable, we put it as a negative. So let's get our number, 1,900 plus 800 plus 4,000 minus 140 minus 1,500 minus 120, 4,940. 4,940. Huzzah, we did it. Yay. 4,940. Alright, let's do a balance sheet. So what we're going to do is we're going to plug the three numbers above. So accounts payable, we're going to accounts payable 15150, the GST payable 4940, and accounts receivable 47180. Now, it doesn't matter what order you put these in, just a heads up, 47180. General rule of thumb, I do like to put bank first, but that's not a hard and fast rule. So we've got all that. So we've got those three we've calculated. Now we're just going to go for the different ones. We're going to do bank first. Now we're going to work down the old balance sheet. So we're going to go look at the May 31st one on top of the exercise. We go bank. So we go bank overdraft now because we know it's a negative bank overdraft of 490. Cool. Then we go inventory. Inventory, always a current asset. How much is it? We scroll down to the dot point and we see it's 66,700. This is the additional information I'm looking at, by the way, if you're a bit unsure. And then I go accounts receivable I've got. The next one is shop fittings. So I didn't buy anything extra, so that stays at 50,000. Less accumulated. I'm going to go Ac Deppen. You should try and endeavor to write it out in full, not be lazy like me. And so the starting amount was 17,100. So that's what they started with. At the start of the month, we had an extra month of depreciation, so we just got to add 500 onto 17,100, which becomes 17,600. And that becomes 32,400. Solved. And then we just got to add our numbers in as is. So 47180 plus 66700 is 113,880. 113,880. Nice and sorted. And let's now do the alignments. Just get our alignment out the way, eh? Alright, so let's go to the accounts payable. Have we got GST payable? Yes, we do. We've got bank overdraft. We now need to do the loan for GH Bank. Now, remember earlier on when I was like, oh yes, 1,500 a month, and then we scrolled down to additional information and the last dot point. It was GH Bank is repayable at $3,000 per annum. 3,000. How much do they owe? Let's have a look at the previous amount. Please note they did pay 1,500. That's an important little bit there. So we go 27,000. So we go 27,000, which was the starting amount, minus 1,500 is 25,500. Now, 3,000 of that is current. So the remainder needs to be non-current, which is 22,500. 22,500. That's the only non-current liability here. So 3,000 plus 490 plus 4940 plus 15150. 23,580. And now we do the owner's equity. So we go capital at start, and this is Melvin, 97,200. So 97,200, add capital contribution. Now I can't do a pre-sum, so I'm going to sort of tie it all in here. I'm going to do all the drawings and capital contributions together. And I just get that from, the cash flow statement, the financing activities. So it's 97,200 minus 1,000, that should be plus 1,000, because it's a contribution, it comes in, it increases it. And then minus 6,200 will give us a straight 92,000. Add profits, which was 8,000, and we get a clean 100,000. And now I'm worried because that never happens. Genuinely concerned, but my little check of the tens column tells me, hey, maybe I am on the right track. So let's do a sum up. So we've got 100,000, that's a million, plus 22,500 plus 23,580, 146,080, 146,080, and then 113,880 plus 324,000. Okay, I'm 200 out. Why is it 200 out? Let's have a look. Why is it 200 out? So we're going to do some quick troubleshooting. We need to do some quick troubleshooting. So that's, have I put the right amount in? Yep, I have. Oh! I know where the mistake was. Alright, this is why I put this amount. 66,700. Is that a right amount? Obviously not, because the rule of inventory cards is we go by the physical count, not the inventory cards. We go by the physical count. So let's have a look. And we see it's an inventory loss of 200. That becomes 665. That becomes 6. And then we'll re-add it. We will re-add it. We go 113,680 plus 32400. 146080. There we go. So I was worried about this side and I screwed up here. Guys, this is what happens. In a SAC, you're going to have those moments. This is a good example of, okay, this is how I troubleshoot on the go. Okay? Troubleshooting on the go, such a key skill in accounting. I cannot emphasize it enough. All right, asset turnover, return on assets. Let's calculate that. So the asset turnover is your revenue, and I did actually bring this up. I am going to direct your attention to the theory behind this. So our asset turnover, so 405, our asset turnover is our net sales over average total assets. So revenue or net sales, we'll go net sales over assets. Is it average assets? It's average total assets. So we just got to grab our numbers from that. So let's go to our income statement, and our net sales is 46800. So that's where we've got to use the income statement, 46800. Average, or the average total asset, so our end was 146080. 146080, and our assets at the start, our assets at the start were, not that one, they were 144750 plus 144750 divided by 2, 145415. 145415, because I got the start plus the end divided by 2. Alright, so we go 46800, divide by answer, I'm not putting that number in, and we get times, that can't be right. Sorry, just double checking. Yep. That is indeed the formula. So we only got 0.4 times. Like, that's really low. Interesting. I'm just going to double check that number. Just check we got that. Yeah, return on assets, that's net profit. We want, where was it? We want, do you want asset turnover? Yes, we want asset turnover, net sales. So we didn't have that big net sales. That's interesting. So our number is 0.32. So we'll go 0.32, and it's 0.32 times. That's quite low. And then our return on assets, our calculation is now, and if you wanted to do this, look at chapter 18, by the way, is net profit over average total assets times 100. So we want net profit over average total assets times 100. I'm going to put the brackets in the right place. I think that might be a good idea. All right, so net profit, let's go. So we've got our 145415. We already got that number. We don't need to put that in again, but we do need to grab our net profit, which was, that should be add net profit, 8,000. there we go, 8,000. And then times that by 100. Alright, so 8,000 divided by 145,415, and now times 100 is 5.5%. Or 5.5%. And I would put it here as well. So that's really low. You don't want that as a business. We want higher. 5.5%, quite low. That means for every asset we have, we are only making 5 cents of profit. For every asset we have, we're making 32 cents worth of sales. That's bad. We're going to back to the exercise. I am zipping a lot over the area, but I'm sure you understand why. So we've calculated that. Now, comment on that bike shop's performance given the industry average for asset turnover is 0.28 times and the return on assets was 4%. We can see that they now clear both of those. So they should be really happy with these results. Now, we said it was low, but that's important because it's context. So that bike shop's results for asset turnover and return on assets should be pleasing to the owner. This is because the asset turnover was 0.32 times, which is above the industry average of 0.28 times. Meanwhile, I can't spell, the return on assets is satisfactory, or is a positive result because that bike shop's result of 5.5% is above the industry average of 4%. So good job there. You love to see it. And so that's everything from me. Thank you for watching along. It was a long exercise, but it does all tie together. So these are the expectations I have of you to be doing this work. So until then, make sure you like and you follow along. You watch some of the videos. They are helpful for the end of year exam and also in year 12. So you can get an idea of what's in year 12. But hey, that's just me. Plus there's some other entertaining stuff in there. So you do you. But I will see you next time.